appropriate term. I think China's market is very difficult to invest now. The two big short-term factors sending it down, of course, are the Shenzhen lockdown because of China's zero COVID tolerance policy, and the regulatory crackdown that China's had with them being more interested in controlling the tech sector and making it clear to the world and the Chinese tech sector who's in charge. Longer term, however, when is China tech going to come out of this, I think is a much more difficult question to answer. And that's because the Ukraine conflict has completely changed the parameters of the global economy in which we operate. In 2019, economic growth was the #1 market driver for share prices, both in the US and in China. Today, the #1 driver is geopolitics. If you look at our thematic scorecards for all of the tech sectors, the big themes used to be artificial intelligence, cloud computing, Internet of Things, quantum computing. Today, the #1 theme impacting tech is geopolitics, and the fact that China is increasingly siding with Russia, and may get involved militarily in terms of helping Russia. That means the world's bifurcating into two zones, a US zone and an economic zone, and the Ukraine conflict has just exacerbated and significantly increased the speed of that separation.
For sure, Cyrus. I mean, for better and worse in that Chinese narrative with regard to it putting itself front and center, not just those old thematic elements, but the new geopolitical ones as well. Ben Harbrick, we have you now. Let's bring you into the conversation here. If you look at China right now, I mean, there have been multiple times when even I thought to myself, it can't get any worse. It has to show some stability. But it has been months and possibly maybe even years at this point since the downtrend began. Is there any sign that you'd be looking for that you would say, hey, maybe this is now a deep enough value where people can get back into Chinese investing?
I'm not sure if we've hit bottom yet, and I think a lot of that depends on the outcome from the Rome meetings and some of the posturing that China will make in the coming days with regard to their positioning with Russia. The causes for optimism, I would say, because it's tough to be such right now, is one, obviously in a lot of these businesses, the fundamentals remain sound. China remains the world's largest homogenous market. Many of these companies, in fact, actually have cash balances near their actual current valuations. You saw today a raft of upbeat economic data coming out of China, be that PMI, industrial outputs, fixed investment, and retail sales. And obviously, many of these companies are significantly undervalued historically, with kind of an average PE of about 9.5 relative to probably what's about fair at 12. So what gives me more optimism, though, is that a lot of this is under the control of the Chinese government. It's not actually blowing in the wind here. So the Chinese government has a lot of bullets it can fire to improve the economy and stimulate growth. We don't have the same levels of inflation here as in the United States. We haven't printed as much money. We obviously have much higher interest rates. The Chinese government can obviously choose to side with Western powers or at least remain neutral in this conflict and give some stability to markets in that way. And more importantly, for our view, is this issue of delisting and regulation. The Chinese government can signal that it is starting to have some light at the end of the tunnel and be very clear and predictable around its listing frameworks, as well as which companies will face regulatory intervention. And ultimately, it needs to decide with the United States which companies will be delisted and what that framework, again, is for data security and audits between American and Chinese listed companies.
Now, are these stocks investable? I mean, between pandemic shutdowns either before or now, Beijing's own crackdowns, possible delisting from the United States, there's just so many problems and issues facing this group.
That's right. And the problem is not so much the underlying fundamentals, though you do highlight some real problems that they have. Higher oil prices are very bad for China. You know, the worst COVID outbreak since 2020, very bad for China. Continued focus on the zero COVID policy, Foxconn shutting down today. Those are big deals. But the reality is these U.S. listed companies, especially the ones that are variable interest entities, which are sleight of hand to circumvent Chinese law prohibiting foreigners from investing in internet companies, are not sustainable structures. They're just not. So no, people should not be investing in these VIE companies. They should be finding equivalent companies or other ways to get exposure to China if they want it. But they have to be careful right now because it's got some serious headwinds.
David, I can't quite figure out what's going on. China, Russia, they had that pact they signed pre-Olympics. I think it was a 5,400-word document that they put out. What are the chances that in this war, they align themselves somehow with Russia? And what does that mean for their stocks or stocks in general?
Yeah, I don't think you're going to see a lot of direct alignment of China with Russia. Europe and the U.S. are much more important to China than they are to Russia as markets and as partners and all kinds of things. So I think you're going to see them trying to sort of thread the needle on their rhetoric, but I don't think you see an outright alignment with them. I think you need to understand that China has some good opportunities, has a good growing consumer class, has an evolving economy, but you've got to invest in it in Hong Kong or in Shanghai, on names that are not these variable interest entity names, because that's not sustainable.
But even so, David, I mean, putting, and these are major concerns, but putting, Russia, Ukraine aside, putting delisting aside, and let's say you're not looking at those VIEs, are even Chinese domestic names at this point worth investing in, given the economic backdrop for China?
Well, the economic backdrop for China is certainly challenging, especially with the resurgence of COVID there. But it's not heading towards any sort of failure. Their balance sheets are much stronger than they were 5 years ago. They've really cleaned up the shadow banking situation pretty aggressively recently. They've invested a lot in their social contract with Social Security, pensions, healthcare, education, that kind of thing. So they're doing some things really right. And you just got to find places to play that. But, people really bet on the tutoring companies, and then they outlawed that. So you really do need to be careful and talk to trusted partners who can have an insight into what's going on the ground, because it's tricky.
Of course, history is changing. I think we're trying to avoid a very bad Cold War. I think that President Xi has complete contempt for us, complete contempt for shareholders, and very much contemptuous of rich people whom he thinks threaten his power. So I believe that this is just all geopolitical. Look, Alibaba's going to do well. JD's going to do well. BIDU could do well. But that doesn't mean that their stocks can translate into doing well. I think that the President Xi does not like capitalism. And he is a return to the old style.
Is there a price, though, at which you would buy into any of these companies? I mean, we're looking at a screen right now.
Do that? Why would I do that?
I'm just asking the question. I mean, you can make the argument that at some point the price is low enough that the risk that it continues to go lower is reduced. I
can do that, but that's irresponsible of me to do that. I mean, I can't recommend buying stocks in a communist regime that is a totalitarian dictator who's not just human rights, but is doing much more than that to be able to solidify his power. I think it's irresponsible for me to come out here and say, you know what? At 108, it's fully discounted that the man is a terrorist dictator. I can't. At 97, it doesn't matter that he's killing a lot of people and that he's retraining people and there's concentration camps, and don't worry about it. I'm not going to do that. They're showing no mercy. It does seem like when you turn a profit company into a non-profit company, what you're trying to do is make it so that there are rich people who are just stripped of their wealth. It's very Maoist. It's Stalinist. We tend not to see that. I think these are very serious violations that make us realize that capitalism is not alive in China. And we kidded ourselves that we thought that the party was somehow going to want to join the rest of the world in being capitalistic. They're not. This is a dictatorship, and we're beginning to wonder. I question every one of those companies that's on that list. Any one of them could be vulnerable. It's time. You got to go. You can't own these stocks. I mean, the party may decide tomorrow that Alibaba is charging the people too much. So I don't know. Andrew, I think we're discovering that they were communists. But they were communists all along.
Is this actually the first time that Jim Cramer had gotten something right? He said not to invest in Chinese stocks, and he was actually right this time, because Alibaba and many others are just getting destroyed day after day. Alibaba is currently below IPO price. Also, Cathie Wood sold all her Chinese stocks.